In an era of global investment, language shouldn't be a barrier, especially the language of business. For decades, Indian companies used national GAAP, but as India emerged as a global economic powerhouse, a need arose for a system that communicated effectively with international investors. Enter Indiana as the Indian accounting standards, which serve as a bridge between Indian businesses and global financial expectations. Indiana as are not merely a replication of International Financial Reporting Standards, IFRS, rather, they are harmonized with them, featuring specific carve-outs and carve-ins to accommodate India's unique legal and economic landscape. Issued by the Ministry of Corporate Affairs under the supervision of the Institute of Chartered Accountants of India, ICAI, these standards mark a crucial shift in how accounting is approached in India. Indiana as is built on four fundamental assumptions akin to pillars supporting a building. First is the going concern assumption, suggesting that a company will continue its operations for the foreseeable future. Second is the accrual basis, which mandates that transactions be recorded upon occurrence, not merely when cash exchanges hands. The third pillar is consistency. All accounting policies must be consistently applied year after year, facilitating comparisons. Finally, materiality ensures that if an error or omission could influence an investor's decision, it must be disclosed. Under Indiana as, the full set of financial statements expands in detail and comprehensiveness compared to previous practices. The balance sheet is now referred to as the Statement of Financial Position, which presents a clearer snapshot of a company's worth. The Statement of Profit and Loss has evolved to include other comprehensive income, OCI, capturing unrealized gains and losses. Additionally, there is a dedicated statement of changes in equity, detailing movements in shareholder wealth throughout the year, alongside the statement of cash flows that tracks the actual flow of money. And finally, notes and disclosures explain the underlying reasons behind the numerical data. A significant shift within Indiana as is the valuation principle known as fair value. Unlike the traditional historical cost approach, where assets were recorded at purchase prices that could be decades old, Indiana as encourages companies to evaluate assets based on their current market value. This transition to fair value offers a more accurate and timely reflection of a company's financial standing, though it does introduce greater volatility into profit and loss statements. Not all companies are mandated to adopt Indiana as immediately. The implementation of these standards has occurred in phases, with Phase 1 beginning in 2016, mandating companies with a net worth of 500 rupees crore or more to comply. Phase 2 rolled out in 2017, making adherence mandatory for all listed companies and unlisted companies with a net worth of 250 rupees crore or higher. Specific timelines have also been established for non-banking financial companies, NBFCs, and banks. Companies may voluntarily opt to adopt Indiana as, but once they decide to do so, they cannot revert to the previous cap. The adoption of Indiana as is a transformative step towards greater transparency and comparability in Indian financial statements, enhancing credibility in global markets. It is more than just a change in bookkeeping practices, it is India's passport to the global financial arena. With Indiana as, Indian balance sheets are becoming globally respected, fostering a more conducive environment for investments and collaboration in the evolving world economy. Thanks for watching.